it's a pretty chaotic time in markets. A lot of volatility. Tech stocks have been getting beaten up going back a couple of weeks. Bonds are selling off as well now. And it's just been kind of a difficult time. And investors could be forgiven perhaps for keeping some of their holdings in cash during this time. But you have a contrarian view on this, and you believe that people should be allocating. And you have a specific view on a stock, a certain Mickey Mouse stock related to that character that we'll talk about in a minute. But for starters, let's talk about this whole allocation thing and why you think it's a better idea now to put money, I'm assuming, into stocks than to hold it in cash.
Yeah, well, first of all, thanks for having me.
Thanks for coming on.
For people who are listening who don't know, we're both Tottenham Hotspur fans. So
yeah, let's not talk about that. But yeah,
thankfully, we don't need to talk about that too much,
right,
because it's been a little bit of a rough season. So we'll talk about something more fun, like the stock market crashing. Yeah, my view on allocations and asset allocation broadly has really been formed by what I saw in the investment advisor world. And what I saw over time was people basically introduced a lot of unforced errors into their investment process by constantly tinkering with their allocation and, effectively trying to market time. And I saw many people try it, and I saw very few do it successfully. And when you do it successfully once, there's always that next question, and then what? So personally, I've taken the approach that the most intelligent way for me to approach it is to think about the allocation in a structural manner. What's your ability and willingness to bear risk? For someone like myself who's younger and I plan to be a net saver for a long time, it makes sense to me that, that level should probably be somewhere around 90 or 100% in equities, given the return profile I expect over, a period of decades relative to the alternatives. So as I think about cash as part of that, if you tell me the baseline is 90 as a starting point, if you want to go 10 points above or below that, I wouldn't argue with it too much. I think that's kind of a behavioral thing that some people, it makes them feel good to know that they took, 5 points off the table, basically. And I don't think you should beat yourself up too much for that. But when I see people start doing things like saying the market's heated, I'm going to go to 20, 30, 40, 50% cash, I just think you start to get into a really dangerous place, and you kind of take your eye off the ball, to be honest. You stop looking at the quality of the businesses and the quality of the investment ideas that you can possibly generate, and you start focusing on something that, in my mind, is a much more difficult game. So I like to keep the focus on the opportunity cost of whatever the most attractive equity I can find relative to, what's in my portfolio. And I think if you keep it at that framing, you can really eliminate one of the biggest errors that people make as part of the investment process.